On March 8th, 2023, the Federal Housing Administration, or FHA, stirred up the mortgage industry, extending the mortgage modification terms from a 30-year to a 40-year. What if I told you there's a product out there where you can buy a home on a 40-year mortgage? You stick around for that. We have YouTube channels coming out and saying it's only for loan modifications. But in Idaho, you can actually purchase with a 40-year mortgage. Potential advantages are reduced monthly payments and increased homeowner retention. And this change has also ignited an intense debate over the long-term consequences. While lowering your monthly payment might seem like an attractive proposition, this advantage may come at a cost. Demand for housing could increase, driving up prices and exacerbating the existing affordability crisis as properties become more and more overvalued and the market becomes increasingly unstable. If you've been sitting on the sidelines, you may want to pay attention. By encouraging more people entering the housing market with the extended mortgage terms, the 40-year mortgage may inadvertently delay the impending housing market correction. Being able to secure mortgages and purchase homes, the market may continue to go unchecked, further fueling the risk of a housing market crash. When the market eventually corrects, homeowners with a 40-year mortgage may find themselves underwater, owing more on their homes than what they're worth. While these extended mortgage terms may offer short-term relief in the form of lower monthly payments, the long-term consequences could be detrimental to both the individual homeowners and the housing market as a whole. The most significant risks of a 40-year mortgage is that the higher overall interest cost. As a long-term loan is extended, you'll be paying more in interest for an extended period of time, resulting in a higher total interest expense. This additional cost may negate the benefits of the lower monthly payment, as you could end up paying significantly more in the long run. Another risk for the 40-year mortgage is the slower pace at which you will build equity in your home. The longer term means it will take more time to pay down the principal balance, reducing the rate at which you gain ownership in your property. In the event that the housing market does go into a downturn, this slower equity accumulation could put you at risk of owing more on your house than what it's actually worth. The other thing you got to consider is the potential risky terms. A 40-year mortgage are not widely available, and finding a lender who offers this loan term can be challenging. And that's unless you subscribe to our channel now. You see, we follow the housing market, and if you want to stay at the latest trends in the Idaho housing market, make sure you like and subscribe this video. This situation could create a curious housing bubble that may eventually burst, leaving homeowners with a 40-year mortgage in a vulnerable position. We're going to compare the 30-year and the 40-year mortgage. So we're going to look at a house of $492. Now, these numbers are going to be a little bit off, but they will at least drive home the point. So for your monthly payment on a 30-year mortgage is going to be $2,989. This does not include if you're using the Good Credit Second, which is going to be an increased payment for your down payment. It also doesn't include PMI, which is roughly around $150 a month, versus the 40-year mortgage, which gives you a payment of right around $2,900. Now, keep in mind, this particular product, you're not paying personal mortgage insurance and you don't need a Good Credit Second because it's 99.5% financed. Right now, a 40-year mortgage, you're looking at your standard interest rate at 6.625. Where a 30-year mortgage, you're sitting at 6.125. Interest is going to be higher for a 40-year than it is for the 30-year. And this difference is because the longer the term presents a greater risk for the lenders. So your total interest cost is going to be $584,000 on a $492,000 purchase. But if you do a 40-year loan on that, your interest is going to be $912,000, almost double of what it would be if you did a 30-year mortgage. And again, this is crazy because now you have added 10 years to your loan and you almost doubled the amount of interest that you're paying. When you're looking at a 40-year mortgage, after 10 years, you've only paid down $35,000 again on a $492,000 purchase. If you do a 30-year mortgage on your purchase of a $492,000 house, your principal pay down is $79,000. Again, over double. So right now, if you're looking at it, a 30-year and a 40-year, you're going to pay more in interest and you're going to have less down on your equity in 10 years. Real risk of the slower equity build pace is we're going into a housing market downturn. If we go into a housing market downturn and now you're underwater, you've had less of your principal paid down on your mortgage. So it's something you really should consider. So what is this program that we're talking about? Well, this program we're talking about is a portfolio loan from Idaho Central Credit Union, a credit union that services the whole state of Idaho. So if you need somebody and you want to talk to a lender, make sure you reach out to us and we'll put you in touch with the one who has given us all this information. And what considers you as a first-time homebuyer? Somebody who hasn't had their name on title anywhere in the U.S. in the last 3 years. So this program offers an attractive financial options. And this is what we're going to look at. So what do you got to do to be eligible to qualify for this loan? So the specific criteria says you got to be a first-time homebuyer, which we just talked about. You can't have your name on title within the last 3 years. You also have to have a minimum credit score of 720, and your maximum debt to income roughly is going to be around 45%. So that's adding up your car payments, your credit cards, any other kind of payments you have, including your new housing payment, cannot exceed 45% of your gross monthly income. The other thing is your income limit. So you cannot make more than 150% of the average median income, which is approximately $130,000 in most counties. Now, the minimum loan amount is $200,000 and the maximum loan amount that you can have on this is $600,000. So you can put more money down than just the $1,000 down. The other thing is it's 99.5% financing and there is no PMI, and that is huge. So let me just break this down for you. Let's say PMI is $150 a month and you have the house for 10 years. So you saved roughly $18,000 by not having any PMI on that house for 10 years. One of the most significant advantages of this program is only $1,000 down. So that means you could go out, if you qualified, and buy a $500,000 house and only put $1,000 down of your own money. But wait, there's closing costs, right? And this is where this product also plays into play. You can get 4%, up to 4% of seller paid concessions to help you pay down your interest rate or buy down your different closing costs. Although the program offers 99.5% financing, applicants must still contribute at least $1,000 of their own money towards the home purchase. This typically covers earnest money deposit. And if your earnest money deposit is more than $1,000 and you only want to put $1,000 down, then you'll get that money back at the end of closing. Additionally, applicants must have a minimum of 2 months worth of reserves to qualify for this program. So you have to have that in the bank, not named for anything. First-time home buyers participating in the Idaho Central Credit Union program can receive up to 4% in seller concessions. This benefit can help you cover closing costs and other expenses associated with the home purchase. My question for you is the 40-year mortgage a good idea? So what do I think this is going to do to the housing market? Well, we did, as soon as we found out that this particular lender, because they are a big lender servicing the whole state of Idaho, they have one of the biggest market shares for mortgages. We started letting our clients know who have been on the sidelines to, hey, you need to be on watch out for this, because if all these first-time home buyers, they could come in with $1,000 down and start buying up inventory, $600,000 or under, it could create another inflationary market where we're pushing prices back up. And the decrease that we saw last year might be going away. Pay attention and watch out, because our housing market crash might have been delayed and now we have a higher increase inflating balloon. And so those who have been patient, it might not be time to be patient anymore, or you might have to wait for many more years before this correction actually hits our market.